Hello, everyone. Welcome to today's session. Let's get underway here. Let me just double check, make sure. I had a little issue on the recording last week, and that didn't process for whatever reason. So just double checking today, and we should be good to go here. Let's start out with a little bit of market discussion, and I'm going to jump over to directly to the buy-sell ratio. We're seeing, well, a couple things. Let's focus on, pardon me, a very pretty aggressive rally off of this bottom right here, and we're seeing that buy-sell ratio starting to, it was wide, now it's starting to come back together again. We're still on that bearish side of things though, so we've had a pretty aggressive rally. We'll see if that continues today, but it's looking like we're stabilizing and continuing the overall uptrend. The sentiment location also did a good job of kind of anticipating this low, and I would have expected a little bit more of a bounce than that one right there. We had one day of that bearish move lower, and now the market has really shrugged off everything and is just full force to the upside. So we're definitely seeing momentum shift back to that upside, which is a good thing for the market to not be super fearful and just be looking for some optimism. Now, that being said, oftentimes the economy could be trailing, but we're not seeing too many things happening in the economy, at least as of this point. We'll see if we continue with that soft landing idea moving into this next year. We're also seeing direction alerts has moved back to mildly bullish, and overall in this bull market. Now, this is going to be, bull and bear markets, they're typically pretty tough to turn. They don't happen real quick, and we're seeing some, this has been a pretty nice uptrend since May. So, and just a bit of a pullback right here. So we're looking for continuation. And one of the things on the short-term momentum indicator is when we've got these three together and we're looking at the sentiment, the breadth, and the momentum all together. Typically when sentiment, there's two sides to this, and it can be a double-edged sword because sentiment can run into two situations. Obviously, if sentiment is high, that is good because everybody's optimistic and there's not a lot of fear in the marketplace. So there's the propensity for more buying and more upside and more bullish perspective. When everyone is bearish, then it's the other way around, and typically that happens, in a downtrend or near a bottom, or in an uptrend or near a top. So when everybody's bullish, that's often when there's nobody left to buy because everybody's bullish. So you start to get some sellers that creep into the market, and so it can be a contrarian indicator as well, meaning an opposite signal. When everybody's bearish or everybody's bullish, then that doesn't create a healthy marketplace. There's got to be one or the other, right? And so everybody's bullish. That can be a contrarian indication that we're near a top. But that being said, this can stay up in this upper range for a long time. During the COVID bull market, this stayed high for the entire uptrend. Okay, so we kind of want that. We don't want to overutilize that. It's like, yes, sentiment is good, things are complacent, the market's going to turn lower. Because when sentiment is good and the market's going higher, that can also continue and have lots of momentum for months and months and months, if not years. So this is, as of right now, taking that just with a little bit of a grain of salt and knowing where we're at, and that it doesn't move very quickly. The breadth and the momentum, on the other hand, do move a lot more quickly. And traditionally, when we get a momentum low first, that's not the low. Okay, we'll usually have a combination, and we'll usually have sentiment that actually leads the market down as well. So some of these momentum moves back down again are, in this case, it turned out to be a pretty healthy, pretty common type of counter trend or retracement. Now, next steps moving forward, well, let's look at momentum because we're still a little bit in that range. Depending on today, we may bump back up into that bullish trending move, and we moved pretty aggressively to that upside right here as well. If we look at a chart on SPY, which is S&P 500, that yellow sometimes is a little bit hard to see. So let me just go over to here. So we're back up into that momentum zone. The momentum zone being this upper range right here. This first initial retracement area in an uptrend is a 236. That's a Fibonacci number, 23.6% retracement of the trend. The next one here is a 382 or 38.2%. And then this is a 50%. So this 50%, when you get a real deep retracement on a stock specifically, or even in a market, that becomes a really solid area for reversal. Anything inside of this 50 to 618 area is going to be a reversal zone. This upper range, when it maintains this upper range, that's the trending zone. That's the momentum zone. As it starts to break down through these zones, then the probability of a bounce becomes less and less, or the probability of it being a different type of move. So when we have a trending move, typically like one of these, a little retracement, a little pullback, within an overall uptrend, it typically will not retrace much more than this 236. When it does, that just means that the shorter term trend is broken and we're working on a little bit of a correction of the longer term trend. And so we dip back down inside that 382 area, which and we're finding lots of support. So that's about all the market wanted, at least for now. So we could have a real clear shot towards these upper highs on S&P 500. Those are not all-time highs, but if we can test those and if we can surpass those, then this market really could have some strength going into the fall. We're still in August and September and October, which are notorious for market volatility. And so my only worry on this last rally here was just the conviction that this is pulling up and then we end up getting a deeper retracement. But we'll take it while we've got it, right? It hasn't happened yet, and it's continuing to move to that upside, and that's going to be our bias now, is continuing to watch. We're getting short term. We already had the long term trend, which was higher, and depending on we're getting a little bit closer. So when that bumps up into this buy zone, then we'll see that on the chart right here. So we're still kind of in that non-trending zone or a little counter trend zone, and obviously price activity is telling us that we've got some strength here, especially after this bar. When you have a really a bearish bar like this it was a full engulfing pattern where you opened higher and then traded lower all day long, and the entire body covers the body of the prior candle. That's called an engulfing pattern. It can be bearish or it can be bullish. In this case, it's bearish. But when you have immediately the next 2 days, 3 days, 1, 2, 3, and immediately erasing that, then this is the probabilities of retracing that all the way back down again are getting smaller and smaller. We would need to obviously retest this first, and if that were to retest and move higher, then that overall uptrend should continue. The only real value in the market direction, obviously, is being in stocks during that overall market direction. We know we're in a bull market. We know we're going to have pullbacks. We know we're going to have these moves up and down. And if we're focusing on the price activity primarily, instead of all the news that's surrounding it and then trying to extrapolate the news items into the price action, that's an impossibility, because there are so many data points, there are so many news items, and what is the exact reason? Well, it's always hard to know, other than once selling begins, there might be one or two catalysts that start the selling, and then it's just the trend and the motion, the momentum, and the algorithms and the human emotion that are linked to that. So in this case, it didn't turn out to be too aggressive in terms of selling. We had some talks of inflation, we had some talks of China, we had some talks of banking issues during this last little counter trend. So markets have moved on. They've moved on past that and already looking forward. And we'll see what that overall trend ends up looking like. On the 1 year time frame, we stretch that out just a little bit, and we've got a little bit of range, kind of stuck right in the middle between these highs and that support area. That 1 year time frame ended up being that really 236 support location, and very close to that on that 6-month time frame. It's almost measuring the same trend. Really, the 6-month time frame is measuring this trend, and the 1 year time frame is measuring a little bit longer term trend. Instead of connecting to this low, it's connecting to this low. So when you're adjusting your time frame, it's not changing from daily to weekly to 5-minute. The software doesn't do that. It doesn't even allow for that. The reason is because this is a system based on end of day data, daily charts and daily bars. And so why even include anything else? Because that just takes you away from the overall methodology. There's plenty of other charting tools out there that have intraday data if you feel like you need it. But what ends up happening typically is a lot of traders are like, well, okay, let me look at the 1 day. Oh, okay, that's not confirming. Let me look at the 60-minute. Oh yeah, there we go. That one looks better. Oh, well, wait a second. Well, let me look at it at 5-minute. Oh, let me look at it tick by tick. And it's just not helpful in terms of strategy hopping and jumping from one time frame to another just so that you can rationalize or justify the decision. If that's a part of the plan and you're moving these different time frames, you may have a system that is saying, I need my 5-minute, my 15-minute, my 60-minute, and my 1 day all to be in an upward trend. And if that's happening, then I will take the trade, at least based on the timing, based on the entry. That may be something that traders do. But in this case, it's a slower moving process. It's a slower moving trade. It is a trade, and we call it trading because we're still buying and selling. We're buying in order to have the stock go up, and we're going to sell and we're going to make a profit. We're not investing long term into buying it and holding it and owning Netflix for the next 10 years. That's a different strategy. That's a fine strategy, but it's just a little bit different approach. So as you're tackling your trading plan and you're deciding what is it that I really want, what is it that I'm really going for in terms of my overall approach, do I want to be a lot more active, or do I want to be a little bit slower? Do I want to be well diversified, or do I want to have a smaller amount of holdings and larger positions? Okay, those are all things that typically have to deal with your emotional tolerance and your financial tolerance for risk and volatility. To say, I've got this money, I absolutely cannot ever afford to lose a dime of it or even have any volatility whatsoever, then that approach is a whole lot different than someone that's saying, I've got $5,000 and I'm either taking it to Vegas or I'm buying call options. Either one of those two are my trading plan. Okay, and there's definitely there's something to that as well. If that's your plan, then go for it. Go put it all on black and see if it works. If it's fun money, if it's stupid money, then that's an idea. What you don't want to do is you just don't want to be hopping around from strategy to strategy saying, well, I heard about this stock on the news. I've seen their trucks drive by, and therefore I think maybe I'll buy it. Okay, if that's your strategy, fine, as long as you've got some risk management associated with it. But in terms of what we're trying to do is we're trying to focus on stocks that are high quality growth stocks in momentum patterns. They're moving up already. The path of least resistance is higher because that path is already intact. The trend is already moving higher. It's just like a locomotive, okay? It's like a aircraft carrier or a big cruise liner. Those things can't turn on a dime, although they're getting better and better. They have some pretty cool technology, but you get my point. It's just a slower moving process to get a really good, strong quality growth stock to turn and the market as well to turn the corner. So what we want is this top-down approach. We want to say what direction long-term is the market moving. So we apply the direction alerts to that. Long-term, we know that we're in an uptrend. Okay, this simple arrow right here just tells us when this crossover happened, but we can also see when this trend really started to shift. The trend started to shift back in October, November, and started to move higher. So we could even start to say, okay, we're a little bit early, but we know that the ship is now turning. and now it's starting to move this direction, and you can see how strong and how long this ended up being a solid trending direction. Now that's a little bit more in question. We really took advantage of this entire trend. I should say, we being the market as a whole has been moving higher, and now are we going to flatten out, retrace, pause, head a little bit higher? And so being at the top of the trend, our strategy may need to be a little bit different than at the bottom end of the trend or at the middle of the trend. And that simply is an adjustment to say, how big of a allocation do I want to have in equities? If you're a Warren Buffett style investor, trader, then he's invested most of the time. He's got a lot of cash, but he's invested most of the time in quality companies that are going to do they're going to do what they're going to do, and things are moving higher over time. So if we can take the approach that we're going to focus on what is our long-term market trend direction, let's be in that direction, meaning let's be in equities, let's be in stocks of maybe 75% or maybe 100%. Okay, and we're going to take advantage of that, and then we're going to be only focusing on growth stocks that have quality fundamentals and good price patterns. That can be your plan. Okay, you could say, no, I don't really care if it has fundamentals, because sometimes I will agree with that the stock price is going to move the way it moves. It's always based on information that's known or information that's anticipated. And so the company could have amazing growth and earnings, but the market may not see it that way. The market may see it slightly different. And so it may be irrelevant in the market's eyes. And if it's going to go higher, it's going to go higher. And it may be for other reasons other than the company. But at the end of the day, the absolute bottom line, and I've said this before, is that a company has to have earnings. If they don't have earnings, or they have decreasing earnings, the stock is going to go down, bottom line. Okay, may not be in the short term, but over time it absolutely will. There's just the stock price is the present value of the future earnings of the company. It's reflecting what the market believes the valuation of the company is. And that's why I like price information so much, because it's a real-time pricing mechanism. And we all have our opinions, right? Everyone has an opinion. That's why there's so many funds and analysts and software and everything else, because we all have a perspective. We all have an opinion, but the market's opinion ultimately is the correct opinion, because that's the mass consensus. That's what moves price trends. And so we don't want to be that black sheep all the time. There are times where we may want to be a contrarian and say, yep, the market is way, way ridiculously overbought. There's just no way on this planet that it's going to continue higher. I'm out. Okay, even though it may be right at the very top of the trend. We kind of felt that, a month or so ago when the market was moving pretty higher. It was due for a pullback. It was due for a correction. And so this top-down approach of what is the long-term market analysis? What's the market doing long-term? Then what's it doing short-term? In the short term, are we bullish or bearish? Okay, we know that we're in a bull market. We know that we're having a pullback, a retracement. We know that this also is not sustainable, just like this is not sustainable, just like this is not sustainable. And we start to move back again. And we also know that where are the edges of those trends? The edges of the trends are the sentiment tab. You can focus and say, here is the edge of the trend. Okay, in the last year, has there ever been a situation where this has been reached, or these upper areas has been reached, and it hasn't moved lower? Right here, it got a little bit choppy, but ultimately it topped out. This was the top, and we had some divergence, and it ultimately moved lower. So when you're looking at a stock chart and you're looking at this sentiment chart and you're saying, I wonder if the market's going to go any higher from here. Well, the probabilities in the short term are not very good that it's going to continue to move higher. When we're stuck right in the middle, like we are right now, or we're at a bottom or an extreme to the bottom, then we may be able to trade around some of our core holdings, because we may, even in a market downturn when things are moving lower, our stocks may be strong enough still that we are not going to sell them. Or they don't give us a sell signal. They just keep moving higher and higher. Some of these muscle stocks, for example, AAOI, it's down a little bit today, I believe. but still it's in this upper range. And you can see when the market really started to top out, this stock still wants to go higher, but it just really has done nothing. Okay, and this is after some pretty big moves already. So it's pausing, but it just hasn't had any real collapse. It's just had a lot of volatility. In some other examples, if we take a look at, I think I saw it in there, STRL. This is one that also had a day or two of a pullback early. If we look at the date and mouse over that, it's August 15th, 14th. So here's August 9th, 10th, August 1st. August 1st is right here. So from August 1st, okay, this stock went from 60 to 80, and the S&P 500 went from high to low. Okay, so there are stocks that are always going to beat the trend, the current market trend, and that's one of the reasons why we want to be in these kind of strong moving stocks, because there's a huge amount of institutional interest in that trend. And if that continues to trend higher, remember, we just are piggybacking on the big boys and their money. And this is a $2 billion market cap stock. They don't have a ton of volume, but their average volume right here is 500,000 shares a day. So if you have a stock that's trading any more volume than 400,000, 300,000 shares a day, that's institutional interest. You have institutional backing, you have institutional volume, and that's what we ultimately want in a quality momentum style stock. Is we want growth in the company, we want an upward trend, and we want enough volume in there to know that there is institutional investors that are buying into this for their own portfolios, that they believe in it, and they believe that their money is well invested in this kind of a trend or this kind of a stock. So reading between the lines is a certain amount of the process of stock picking, because in our scenario, we're looking for, as long as it's moving higher, I don't care really. I want to see where I'm at in the trend. I want to see fundamental value. I want to see ROE up. I want to see annual EPS up. I want to see quarterly EPS up. I want to see sales up. Okay, this stock, as far as those four criteria, which are the four criteria I primarily focus on for fundamentals, it's cruising. Okay, and the market agrees. The market loves it right here. And so as we're looking for stocks, we want to find more like that. And that's what the Muscle Stocks group does. Okay, so the new buy list is going to take you from any stock on any rank. I think we've got it set to, what is it, $2.70 or higher. So, and really it's, there's more than enough stocks in here, but sometimes you may find one, it's like, oh, I know that stock, I'm going to take a little bit closer look, or spend a little time on some of these other stocks. Even though the rank is not strong, it's pulling them in. So it's sorting it by rank, and it's gone from either a hold to a buy. Well, they've all gone from a hold to a buy. There might be some that have gone sell, hold, and then buy, but everything in the new buy list has just gone in the last day from a sell to a buy. Let's look at the signals on that so you can see. And this is as of today. So this scan would have been as of last night and yesterday. And so it's up a couple of percent here so far. And also some good fundamentals. You've got 30% ROE, 40% EPS annual, 30% last quarter, 7% on quarterly growth, 400,000. That 0.4 M means it's 0.4 million, which is 400,000. Okay, so I've got plenty of volume, and I've got a nice rank, and I've got a pullback, and I'm back up in the trend zone. Okay, so in terms of execution of finding stocks to look at, you could say, all right, this is going to be a candidate right here. I'm going to add this in. I've been adding back into the Muscle 10 portfolio. So let's look at that a little bit here and see some of these. So some of these, let's take a look. So this is essentially when you're managing a portfolio, this is one of the ideas to be able to approach that, and that is, how much capital am I putting into this trade? I don't have a lot on these currently. A lot of it's just for example, but it's also that I want to keep a little bit more cash maybe not this much. I'm going to add a few more holdings. I'm going to eventually get this up to 20. So that's a muscle 20 strategy. Got a muscle 10, but we'll add a few more in there just so we can follow them and track them. What ends up happening, if you'll notice along here, is you may have a situation where you've got one of them that is doing pretty well. Okay, two of them that are doing pretty well, one that's not so much. Some of these, you may have 2 or 3 or 4 of these stocks that they just take off and they keep going and going and going. And we just continue to hold them until they have a little glitch or a little hiccup. So let's look at TAST and see what it's doing. So it actually has had that pullback inside of that momentum range and never had a sell signal, number one, and really didn't dip back down that's exactly what we want to see. We also have support right here. So it's pulling back inside of that momentum zone, the 236. Remember, to activate this, you just have to click on this button right here. And it's an automatic snap tool that will find the highest and lowest points on the chart. Okay, so whatever is the highest and lowest point, it's automatically going to find them on that chart on the time frame you're looking at. So if I click to 3 months, it's going to grab that low and that low. So here, a little bit more volatility. That 3-month time frame, it's pulling back to a 382, which is also fine. The shorter the time frame, the more volatility that you're going to see, and the longer the time frame that goes out, the least amount of volatility, at least within that range. It's changing the ranges. So here you have this huge uptrend. So if you're looking at a 1-year chart, you could say, oh, it really could pull all the way back to here and still be up in that momentum range. It may give us one of these, may give us a sell signal. And I've mentioned that before, is depending on your method, depending on your strategy, to say, okay, I'm going to sell first and then I'm going to ask questions later. Okay, and in the muscle 10 strategy, that's what I'm going to be doing here. Is if we get a sell signal, that'll be the exit instead of the momentum range or set. Even though I have stop losses, the stop losses are primarily for that initial capital amount, whichever comes first, the stop loss or the sell signal. Then I'm going to exit and I'm going to go back out. And ideally, I can go to the muscle stocks new buy list and I've got a new stock that is above 99 or even 98 and has a new buy signal. Okay, then I could replace it. I could replace the stock if I don't already own it with that one, or whatever other methodology that I want to use. Because the muscle stocks is not pulling in fundamentals, you'll notice that some of these, they're just still speculative stocks, like this one, AAOI. It's got some earnings, but nothing fantastic. And so I'd have to go in and like spend a little bit of time and say, what's going on here? Why are these guys growing? We know that it's electronic semiconductors. Maybe it has something to do with AI. And go in and spend a little bit more time. We've done that, I think. I think we actually did connect on that. We went out to Google and we went down to their website and looked at some of these things. Oh yeah, lasers, diode lasers. Just some fascinating, fun technology. I'm just fascinated by companies and what they do and how they do it, and how we can ultimately be a part of what their amazing ideas are, and then try to find those in a way that is systematic, to say, okay, these are strong groups and these are moving higher, and I'm now going to do my research on this. Or you could say, okay, I've created this scan. I've created, in this case, we've talked about this 555. Okay, got 36 stocks in there, and the criteria for the 5 is that I'm setting everything inside of my fundamental range of at least 5. ROE, annual EPS, last, and sales, they all need to be at least 5. I can change that, but if I'm pulling in at least 5, then I know that they're at least doing pretty well. We know that they've got some good looking earnings here. In fact, ELF had another move. Good grief. I mean, this thing just will not quit. A pullback, filled the gap, found some support, marching higher. Fascinating stock right here. And STRL, we just looked at that one. VRT has been really cruising along here too. Now at some point, they're, depending on when these things get really up into the stratosphere, there's always that risk. There's always the risk of it being at the top of the trend. and it reversing. And so we always want to make sure that when we're entering a trade that we have an appropriate level of risk management determined in advance to say, okay, I trust this overall trend direction should move higher, could move higher, but what happens when it doesn't? I don't want to just blindly never set a stop loss, especially on the very first trade. Once the trade is working and you've got some gains and it's moving higher and it's maybe bumped up above a new area and you can adjust that stop loss, you always want to have a stop loss for risk management and have the position size relatively small. Okay, if 10 holdings in a full portfolio is too risky, too aggressive, pardon me, I'm gonna grab a drink here. Then don't do it. Okay, then use half of your portfolio. Use the 10 stocks in half of the portfolio. You can still focus on 10 or even 20, but that allocation part of it is important. Or you could just flat out do, kind of do what I'm doing here, and that is you're going to diversify out a lot of the risk, but that also can be diversifying out a lot of the return. If I'm so diversified that I end up with 200 stocks in here, yes, they all might be great and they all might be moving higher. And as one sells, I add it with a new buy, and ultimately it tops out. I'm actually going to test that on this one. These are the YouTube video updates that I've been doing. I'm adding those, and we're buying every single one of those, and I'm going to track it, and so and see as those updates. And I'm simply just pulling some of these top stocks at the time. They've got to be 95 or higher. They've got to have good fundamentals and all the analysis that we're doing there. And as one drops out, we'll add another one. And when we add it, we buy a new one, and maybe we have another one that sells off, and see how many we end up getting before we have to sell something in order to buy something. I'm curious on that, and so we'll do a little bit of an experiment on this, and watch some of these stocks as they're moving. They're all going to be great, fantastic trending quality stocks, but I don't know which one of these ultimately the market's going to decide is 100%er, a 200%er, a 500%er, and one or two of them will catch that big trend. One or two of them will fall off the couch, okay, and that's okay as long as it's not a big amount of the portfolio. Okay, a couple questions in here. Question is, what's the best to get into the Muscle 10 if we don't have any positions right now? So the best way to approach it is you can do two things, okay? Number one is you could start out by taking the new buy over the next 10 days, okay? So spread it out over a 10-day period of time and say, okay, this stock here, this is the new buy list, and determine the scan, okay? Also determine the scan. Like, let's say that I want to use this 555. So I'm going to say I'm only going to pull stocks. The only problem with that is these are not new buys, which is okay as well, as long as it's in that upper range. I could say, okay, I like it, but it's moved a couple of days out of this hold. I still may add that in. Okay, so just a pure Muscle 10 strategy is going to be taking the muscle stock group and buying the top 10 stocks. And when one of those stocks gets a sell signal, you replace it with a new buy. But the new buy has to be also high ranking, 99 or 100. Okay, and then you're basically buying a new muscle stock that has that is got a little bit better buy setup, or may have a little bit better buy setup because the momentum is starting to turn with that new signal, versus some of these that may be already pretty deep in their uptrend. Some of these also may be like this little one, this little $3 stock, where 378. It's moving higher. It's got a pullback, big rally, and then a pullback. Sometimes people have a really hard time looking at this chart and saying, yeah, okay, I'm comfortable buying it right here, because they're looking here and they're looking here and they're looking here and they're looking here and they're thinking, man, it went from $1 to $4. What if it goes back to $1? Or what if it pulls back at all? Or it just becomes a mental issue of knowing where the low is and knowing where the high is, because our brains, for whatever reason, we want to we want to feel like we've bought here and sold here. We want that. Well, what's wrong with buying here and selling here? Okay, we obviously can't go back. We can't turn back the clock and say, okay, yeah, next time I'm going to buy it here, I'm going to buy it here. You could do that, but in terms of an approach, it has to be a methodology. What is my methodology? So in this case, I could say I'm going to buy a muscle stock as long as it's not extreme. So some of these muscle stocks may be extreme. Let's scan through them. Not extreme. It's gone from a hold to a buy, a little bit of a pullback here today. So that's still a decent setup. The next one here, IRN, pulled back into the hold. I'd wait on that one. I'd sit tight on on that one. MNSO, gapping higher, but it's extreme. Okay, so some of these I don't want to buy into a new muscle stock that's extreme. Ideally, okay, you can do whatever you want, honestly. And I mean, I say that meaning, if that's what you want to do, then do it. Just make sure that your risk is you have a reason why you're doing it, and your risk is taken care of. You know at what point, if you're wrong, how much it's going to cost you and where to get out. So that's extreme as well. I would pass up on that one until it pulls back. MOD, nice setup right there. MOD, I did an update on that yesterday, and it's got a really nice bullish profile. Really cool company as well, and cool. Literally, they're a refrigeration company and heating and air conditioning company, dealing with semi-truck, tractor trailers, and lots of other things. And it's like, man, what I would have never thought an auto parts company could go from 29 to 40 within 3 or 4 months. So sometimes we also get surprised by the companies that show up in these lists, because we're not analysts that have this group of stocks. Okay, I have 100 stocks. I'm an analyst for Goldman Sachs, and I'm going to know every single thing there is to know about these stocks. And I guarantee you, they've got an analyst for every single sector and every single industry, and those guys know the ins and outs and every single thing that's working and not working with these companies. And then they're passing that on to their fund guys and saying, yep, this is a good one, buy it. So then they pass that on and they buy it. Well, we just want to see that. We want to see some general idea of what it's doing and that overall trend. From there, you could also say, and I think it is a good practice to know what you're buying, because there are a little bit longer term trades. It's not a day trade where you're just buying and selling. There's better vehicles to do that in, inverse ETFs, or just a flat out SPY or the Qs, to be able to take advantage of that. But for this methodology, we really are buying into the trend and momentum of the company and the growth story of the company. And if it keeps growing and growing and growing and goes up 1,000%, then that's what I want. Okay, or even if it goes up 100 or 50 or 20 or whatever, and it's not going to do it in 20 minutes. It's not going to do it overnight. It might, but there's so much out there right now on aggressive day trading, and it's just really hard to do, in my opinion, consistently, without having consistent losses. What is a lot more consistent is to be able to slow things down, focus on trend, focus on the company, and then build a portfolio methodology that is consistent, so that you're not just buying stocks because I know, well, I like Home Depot and I like Costco and I like Walmart, and so let's buy their stock. But what am I going to do if it drops? I don't know. What am I going to do when it goes higher and I've got some profits? I don't know, right? Those questions, and we've all asked them, every single one of us in the investment trading world, and we ask those questions all the time still, of saying, what am I doing? Why am I doing it? And what do I want out of this? And what happens when I'm wrong? Because we will be wrong. We just have to make sure we're diversified so that it doesn't hurt us. Losing capital is the most painful thing. That is the worst thing in terms of significant capital. If you're down and you have normal portfolio volatility, 2, 3, 4, 5, even 10%, but having a big loser and a big trade that pulls you down by tens of thousands of dollars or hundreds of thousands of dollars and not doing anything about it or not knowing what to do, that's the worst case. That's just the worst case scenario, because a stock that, if a stock drops from $10 to $5, that's a 50% loss. Well, to go from 5 back to 10 is 100% return. I've got to have a 100% return to offset a 50% loss. Okay, so the upside is a lot harder to gain than the downside is to lose, and the percentages don't work the same. If you're down by 30%, you need something like a 50 or 60% return to get back to break even. 25% loss, so the upside is just harder to achieve on a percentage basis. So managing that risk to the downside is critical and not that hard to do. Honestly, we just have to be okay with it. There's a mental game when we have to admit that we're wrong, and trading and investing is not about being wrong, because it's about making money. Okay, and so it's like it was just a trade. I've explained this before. It's like I'm coaching these little league football players, the little 11-year-olds, and we talk a lot about the last play. The last play, you just need to forget about it, because it's over. All you've got to focus on is the next thing. And if you go into the next play worried about the last play, you're not going to be able to execute on this next play. And really any endeavor, we beat ourselves up a lot. And if we just say, okay, I'm going to create a plan, I'm going to stick to my plan, I'm going to know where my risk tolerance is and my ability to be able to manage that, and then I'm going to invest accordingly. And then there's that creates a certain amount of confidence. The plan can create additional confidence. So going back still to your question, Dave, in terms of building it out, you could take this existing list and go through it. Market conditions need to be bullish. Okay, so we're almost there. We really are there. We're in a bull market, but this buy-sell ratio is a little bit concerning. We could have a pullback because we're working in the right direction, but we still have a little bit of a bearish bias. That is starting to shift. So you could also add that into your plan to say, I'm not going to buy anything new unless we have a buy-sell ratio that is green, okay, or a buy-sell ratio that is 1 or higher, which essentially is going to be green. If I look at this number and I see these high ones right here, okay, 3, 2, 2.5, 1, that's the distance right here. So anything higher than 1, you're going to have green above red like this. Anything less than 1, you're going to have red above that. Okay, less than 1, let's look at that down here at the bottom. So currently our buy-sell ratio is 0.61, which is getting closer to 1, right? And down here at the bottom it was 0.1, 0.2, 0.16. It can get a lot lower than that, but in terms of adding into new positions, you could say I really would prefer to have an uptrend. That being said, there is something to be said about just the stocks themselves, because as we pointed out, there are going to be stocks that work whether the market is going up or down, and that's kind of this strategy of looking to buy. I don't know that I would do this in a live portfolio of buying a new holding every single day, but what I want to see is, if I do that, how soon do some of those start to drop off, and do we end up with a rotating portfolio of 30 or 40 stocks, and overall we end up, because what we're doing is we're buying the new trend every day, we're buying the new winner every day. Or I shouldn't say the new winner, the new strongest stock in an uptrend on that day, and that might be the one that really runs. Okay, you never do know. Instead of going to this list and saying, all right, well, which one of these do I really want? Well, I really like Nvidia, but they're way down on this bottom. But these are all 100 and these are all 99. So there still has to be a little bit of a strategy in terms of, well, how would I filter out this group? Step number 1 is, don't buy anything that's extreme. Here's INOD, it was at that upper range, is starting to pull back 5%. Okay, so that starts to pull back. Watch to see if it holds some support right there, but it's not extreme. What was the one we just looked at that was extreme? Was it ARDX? We'll find one here. That's still in the buy zone. So if you're looking for stocks that are inside of the buy zone, initial risk capital with a stop loss that you're comfortable with. Now, again, the way I would approach that is just simply, you could use this portfolio tool to say, okay, I'm going to go here. I've got 100,000 or whatever that number is. And in this case, if I bought 1,000 shares at $3.78, and let's say I set my initial stop loss down right below that 382 number, that's 293. So let's say 290. So 290, what that does now is it lets me know that I've got, of my entire $100,000 account, I've got 0.86% at risk, which is about 1%, a little bit less than 1%. I have $800 at risk. Is that too much? That's 23% of the trade. That's a stop loss that's way down here. Okay. Well, if it retraces and moves all the way lower, chances are somewhere in here you're going to get a red sell signal anyway. So at least setting up the initial stop loss so that you know, am I okay if I lost that? If things just immediately reversed and I'm scratching my head thinking, what the heck just happened right here? And I get stopped out, you could say, well, okay, yeah, that's no fun, but I was okay with it when I started out the trade, and so I'm going to let it go and I'm going to move on to the next stock. If you're not okay with that, you've got to change one of two things: the number of shares. Okay, let's say that 1,000 is too big of a position, 3,700 is too big of a position. Let me go down to 700. Now I've got 26. Let's go to 600. Now you can see what that's done. That's cut my risk in half. Instead of 888, I've got 528. And it's also lowered my position size, but it kept my stop loss here. So I could say I really don't want to get prematurely stopped out, just in case it has some volatility, maybe it dips down, and then ultimately it does start to work. That allows you to have some volatility range without the gut-wrenching roller coaster ride of a position that's too big. It's always going to be that. The position size is going to be the one that ends up coming back to haunt you, because that's the one that you're thinking, okay, here we go. I like this one. This is the one. We're going for it. We're swinging for the fences, and it doesn't work. So there has to be some consistency in that approach to say, all right, I'm just going to do, in this case, I've got $2,000 of my 100,000 invested in this stock. The greedy part of us says, well, that's what if it doubles and that 2,000 goes to 4,000? I've only made $2,000 or 2%. I've increased my portfolio by 2% because that stock doubled. If that's an emotional grind as well, then you might have to go to a bigger position and a smaller stop loss. Okay, those are the only two things we can adjust each and every time. So let's say, all right, I'm going to have a tight stop here, and I'm going to go 325 instead of 290. I'm going to go 325. Oops, let me get a decimal point in there. 325, and I'm going to go. So now that my stop's 14% instead of 23. My position size, I've dropped this number down. Notice this number went from 0.5 to 0.3. So I can bump up my position size now. Let's go back up to 800 shares. Let's go back up to 1,000 shares. Oops, 1,000. Okay, so now I'm back to where I was with a 23% stop. I still have $530 at risk, but I have a lot bigger portfolio size, almost twice as big, I should say, of a position size. If I was like 2,000, what if it doubles? Okay, now if it doubles, then I'm going to make 4,000 or 3,700, increasing my portfolio by 4%, but I have a tighter stop loss. So I'm not willing to let it do I'm not willing to let it dance around too much. It's got to get there, and it's got to get going, and it's got to keep moving higher. Otherwise, I'm not interested. I'm going to cut my losses quickly, let my winners run. And those are two approaches that you can do. Either one of those are fine. The only difference between the two are how emotionally am I managing this trade? Because one gives you a bigger position size and a tighter stop. One gives you a smaller position size and a wider stop loss. Those are the two things that we can control on risk management: is our position size, our number of shares, and our stop loss. Okay. That, if you've been in any of the webinars for any length of time, then you're rolling your eyes, because we talk about that a lot. Those are the two things that we can control. And then we don't have to stress. The market's going to do what the market's going to do. A stock's going to do what it does. I've got zero control over the outcome once I've set it up. So why should I worry? Why should I even think twice? Once I'm in a trade, it's just going to do what it does. I can't cheer for it. I can't root for it. I can't, pray to the stock market gods for it. Although sometimes I do, right? I think we all do a little bit, but it's just a scenario of, do I have the right pattern at the right location, in the right kind of stock, in the right kind of pattern and momentum? From there, do I have my position size accurate? Do I have my stop loss accurate? And by accurate, I mean in accordance with my trading plan, in accordance with the amount of money I'm willing to put on the line to try and grow that capital. Because at the bottom, at the end of the day, all we're trying to do is grow our capital. And this is one way to be able to do that. There's a zillion ways, zillion's a number, to be able to do that. Okay, I'm running a little bit long here. I'm going to finish up on that note. Just to summarize, market conditions, we're still looking, getting some momentum here, some bullishness. I'd watch that buy-sell ratio. We could pull back. We could have a day or two of a pullback, but I think overall that overall trend still looks pretty nice. Okay, we'll finish on that note. Thanks, everyone. I appreciate your time and effort, and we'll see you next time. Bye now.